Hey folks, it's Jerry again, and I'm going to try something totally new with you guys that I've never done before. So if you would please give me some comments on it, whether it was good, bad, how to improve it, whatever, I would love to hear that. Okay, so the last video was on the basic accounting equation. So this time what I want to do is I want to take the transaction analysis that the textbook uses and show you kind of the thought process that makes it turn into journal entries. So the basic accounting equation is assets equals liabilities plus stockholders' equity plus revenue minus expenses minus dividends, because if you remember, the revenue, expenses, and dividends all flow in and become a part of the retained earnings that is in stockholders' equity. Okay, so that's an important concept that everybody needs to get. Okay, the next thing I did is I put in what the normal balances are. So NB is normal balance of assets is a debit. And the asset accounts that we are using right now are cash, accounts receivable, supplies, inventory, and equipment. Liabilities, the normal balance is a credit. You always increase with the normal balance and decrease with opposite the normal balance. And the liability accounts we're going to be working with are accounts payable and notes payable. Stockholders' equity, normal balance is a credit, and we'll be working with the accounts common stock and retained earnings. Revenue, normal balance is a credit, and we'll be working with service revenue, rent revenue, interest revenue. Expenses, normal balance is a debit. The expense accounts are wages, salaries, supplies, utilities, interest, property taxes, and advertising. And dividends, normal balance is a debit, and we simply call them dividends. So I'm going to take 10 transactions and show you how it works in the transaction analysis, and then show you the thought process of the debits and the credits for the journal entries that we'll be making in the next chapter. So transaction number 1, the stockholders invested $15,000 in a new company. So the company received cash of $15,000. Cash is an asset, so assets increase $15,000. And the stockholders' equity, the company issued common stock, so those shares increased, and that account will increase by the same $15,000. So 15 equals 15. If the company's cash increased, we're going to debit cash. You increase with the normal balance. And common stock also increased, which is a credit because the normal balance of common stock is a credit. I hope that makes sense. Let me know. Transaction number 2. The company purchased $7,000 of equipment and paid cash. So equipment increased, which is an asset, and cash decreased, which is also an asset. So plus 7 and minus 7 equals 0 equals 0. So if equipment increases, we increase with the debit, so debit the equipment account. Cash decreased, so we're going to decrease with opposite the normal balance, which would be a credit, so you credit cash for the $7,000. All right, transaction number 3. The company purchased $1,600 of supplies on credit. So we're going to put those supplies into an asset account called supplies inventory. So our assets increased, and because it's on credit, that means we charged it, and accounts payable or our liabilities will also increase. So if supplies inventory increases, we increase that account with a debit, so debit supplies inventory, and we're going to credit, whoops, I need to change that, don't I? Let me get that fixed. We will credit accounts payable. And the accounts pay, and because we do that because it increased. Glad we caught that. Okay, so far so good? Transaction 4, the company performed some services and the customer paid us cash of $1,200. So our assets increased, which is cash. We increased cash with a debit. And we earned our revenue because we performed the service. We record revenue when we earn it. So when service revenue increases, we increase service revenue with its normal balance of credit. So debit cash, credit service revenue when we perform a service for cash. Transaction number 5, the company purchased advertising on credit. So the liabilities will increase because we charged it. Expenses will increase because we incurred the advertising. So I will debit the advertising expense. That's how I increase an expense account. And I will credit the accounts payable. So my debits equal my credits on that. Number 6, the company performed $3,500 of service. So what happened was we did the work, the customer paid us part of it, $1,500, and they put the rest of it on account, which is going to come to $2,000. So cash and accounts receivable both increased with this transaction, and service revenue increased. So we're going to debit the cash for the amount of cash we got, the $1,500. We're going to debit the accounts receivable so that we know the customer still owes us $2,000, and I will credit service revenue for the full $3,500. So this is called a compound entry when we have 3 or more accounts that are debited or credited. A simple journal entry is what we've been doing before, where it's just one debit, one credit. Journal entry 7. The company incurred the following expenses and they paid each one. So when we incur expenses, that's when we want to record them. We have some rent, salaries, and utilities, all that we paid. In reality, the company would write 3 different checks and you'd probably have 3 different journal entries, but we're just going to put them into one journal entry. So our cash, we paid them, so cash decreases. And that would be with a credit, and our expenses increase, and the increase in the expenses will be debited to each account. So I'm going to debit rent expense for the $600, salary expense for the $900, and utility expense for the $200. So 6, 9, and 2, $1,500, $1,600, $1,700 it should balance. Number 8. The company paid for the advertising that they purchased up in number 5. So let me go back up to number 5 right here. And where the company purchased advertising on credit, we had credited accounts payable. So now I want to decrease my accounts payable by debiting it, and I'm paying it, so I'm writing a check. I'm going to decrease my cash with a credit to cash. All right, number 9, the customer from number 6 came in and paid on their account. So let's go back and look at number 6 again. This is where we performed the service and the customer paid us part of the money, and then they put the rest of it on accounts receivable. So they owed us $2,000, and they're coming in and they're paying us $600. So our cash will increase, and our accounts receivable will decrease by that $600. And they still owe us then another $1,400, so we don't want to forget that. So our journal entry would be debit cash for $600 and credit accounts receivable for $600. Then our final entry, our final transaction, is we're going to pay our shareholders some money. It's $1,300 in dividends. So if we pay it, cash decreases, which is a credit to cash, opposite the normal balance. And the dividends will increase, which means we're going to increase with our normal balance of a debit, so we debit the dividend account. Okay, I'm anxious to see what you think about it and tell me how it works. Okay, bye.